Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically the pro forma cash flow analysis. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. A pro forma cash flow statement is a hypothetical projection of your future cash flows based on certain business activity assumptions for your operations, investing, and even financing. Assuming deteriorated conditions exist for you, the cash flow statement will be used in your negotiations with the creditor by showing the cash flow levels you absolutely genuinely expect to generate over the next year or so to repay your debts. This is probably one of the most important repayment tools that there is. It is expected that you and the creditor will come to a consensus on the loan repayment terms that align with your projections, how you see it, especially as you articulate your assumptions, those assumptions that drive the numbers, getting to a win-win agreement with the creditor. This will help meet the prudent lending standard most lenders are required to abide by. There's nothing quite like a well-supported, documented repayment plan that is originated, presented, and sold to the creditor by the debtor. So why is your global cash flow projection important to you? First, think reasonable, supportable, documented assumptions and conclusions behind those projected numbers. At the end of the day, a well-prepared business cash flow pro forma statement, like I said, is one of the best tools to use when negotiating a workout situation, or a loan modification, or even an extension or payment deferral. Special attention must be paid to the actual and expected cash flows in a potential workout situation. If you're in a deteriorated financial condition, analyze your financial statements and identify precisely why and for what reason the deterioration has happened. You have to know the root cause. If you can identify the actual reason, you can apply the appropriate corrective action to fix the problem. You may have to make material adjustments to these activities that you're doing already, and those changes will be reflected in your pro forma cash flow statement as documented assumptions. Remember full transparency and be reasonable. You will show the creditor the availability of cash flow and when he can expect to receive his loan repayments. You will have documented, perhaps not what the creditor expected to see, but your best estimated or most accurately estimated cash position on a monthly basis for the next 12 months, or even quarter by quarter. Make sure, again, it is reasonable and that barring any unforeseen emergency, you will hit those numbers, even if they're bad. Be detailed and explain. In other words, write it out. Specifically, the material assumptions behind achieving the projected numbers. There needs to be a thorough mutual understanding of your assumptions between you and the creditor. You sit down and you convey why you think your assumptions will actually make sense and work. If they're deemed to be reasonable and supportable, the documented plan should materialize, right? That's what lenders need. Lenders need to be prudent. That's how you prove that this workout situation is prudent. Next, just tell the truth, regardless of how bad the numbers are. Again, depending on the severity of your financial condition, you may need to prepare the cash flow statement to include amounts month by month for the next 12 months, quarterly, semi-annually, or annually. If there's risk of imminent failure, cash flow statements may need to be prepared daily as well. There's a lot of deals that have daily reporting if they involve, for example, accounts receivable. Cash flow statements will show the stakeholders your estimated cash position, but be sure to not just appease the creditor by showing the cash position you think the creditor wants or expects to see. Rather, make sure you estimate precisely the numbers you are very confident you can produce, regardless of how bad or good they may be. If the numbers are not good, then so be it. That's why it's called a workout, meaning that there will need to be modifications to your loan documents that reflect your ability to repay. The cash flow statements can and should be regularly refreshed before the creditor even asks for it, frankly, and additional modifications be made as well. Make sure you clearly understand that the cash flow statement reflects what you're comfortable with. These are your numbers. It's your business. You know, and you're making the assumptions. Make sure you're comfortable with those numbers, because lenders may not be all that forgiving. Like if you're fudging numbers or you put numbers in there you think they expect to see there and you don't, and you know that you can't achieve those, you've got to be serious about this, especially when there's an economic downturn. Their job is to ensure your loans are repaid to an acceptable pass risk grade as soon as possible, or to a zero balance. Hopefully you get the picture. There's going to be pressure coming from their end, and thus upon you. Doing this wrong by overestimating your cash position will likely result in a stressed relationship, if not worse. So tell it like it is. Next, prepare and report the cash flow statement as needed. For smaller, less complex small businesses, it's reasonable to simply prepare, say, a single cash flow statement month by month for each of the next 12 months, plus the 12-month total, and simply list all cash receipts, your inflows, all cash receipts, all cash inflows together. This would be like cash sales or collections from accounts or notes receivable, sales proceeds from property and equipment, sale of investment securities, issuance of stock, proceeds from new borrowings, and cash from whatever other sources. Now, the same holds true for cash disbursements or the outflows. So this is on a simplified cash flow statement. All the cash receipts. Now we're talking about the cash disbursements or the outflows. That would be any property or equipment purchases, investment securities purchases, inventory purchases, general operating and administrative expenses, wage expenses, interest expense, principal payments, and income taxes. All these things are cash outflows. When modifications or loans are restructured, it is imperative to repay the enhanced contractual terms on a timely basis. You have to pay according to the new modified terms, period. Refreshed financial reporting is warranted anytime there are material changes to your operations, favorable or otherwise. So you can refresh them at any time. Okay? The level of detail, for example, whether they're monthly or quarterly reporting, will likely depend on the level or severity of credit risk and the size of the loans, and will either increase or decrease as those conditions merit. Now, it's acceptable to, like I said, revisit or revise already modified repayment terms, if necessary. You just give them refreshed financial reporting. You redo the projections. You own this, and your candor will hopefully pay off in your favor. Again, debtors should repay their obligations in full, as this is not an exercise to see what debt you can get out of paying. Liquidation strategies are a different story. But remember that you should have the opportunity to make your case on a best efforts basis, getting to a win-win solution, including terms you propose. Thank you for joining us. Today we covered another great creditor tool, probably one of the best, called Forma Cash Flow, as debtors prepare to propose their own repayment solutions. But we want to hear from you too. Share your own credit risk memo and debt repayment experiences, questions, inputs, recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.